Namaskaram. Today we have our interview series with Mr. Ankit Agarwal, fund manager from UTA. He is managing midcap, UTA midcap, UTA small cap and innovation fund. And before coming to UTA as a fund manager, he worked in Lehman and Barclays, then Centrum also in Mumbai. So that time we were neighbors. I was working from the next building, but we haven't met that time. But thanks because of UTA's support, we got an opportunity to meet now. And he has done his education from IIM Bangalore and NIT. And even when you are doing your MBA in Bangalore, I was there in Bangalore also. I was working with Reuters.
Okay.
Then we started Pendad. Then that time we started in Mumbai. Then I came to Kerala. Before COVID itself, I came. And with the UTA, we have a long-time relationship. Even in last time when I did the interview with other fund managers, I mentioned that my father had even still have a UTA agency.
Okay.
My father is a LIC agent. So UTA, when they started, he has taken that unit trust agency, and that too he got the agency on my birthday.
Okay.
So that was very close association. Okay. So thank you, sir, for taking time out for us. And today we speak about a mutual fund and in general, and mid cap and small cap in really particular. And to have an introduction about yourself, and at the same time how you got attracted to capital market and enter into the space of stock market.
So actually unlike a lot of fund managers who might tell you that they were into stocks right from very early stage, actually I, in spite of growing up in Gujarat, never got a chance to really look at stocks, etc., or stock investing. And I always wanted to do futures, options, because I during my after engineering, I joined D. Shaw on their options desk.
Okay.
And I thought that this is something something which I found interesting. It was a bit mathematical, and I was always bit into logic and maths. And from campus, I ended up joining Lehman Brothers and joined them in their London office. But fate would have it, GM, the whole financial crisis happened, and I came back and I talked to someone in London itself who was saying that they're setting up a wealth and investment management arm in India, and why don't you consider? So I ended up joining here in India in the equity research team, and that's where I started looking at the broader equity markets, and actually mid and small caps in particular. So right from the beginning of my career, I've been looking at mid and small cap space.
Okay. So in terms of I'll before moving on to mid cap and small cap, could you define, according to you, what is mutual fund for the audience to understand? According to Mr. Ankit, what is this called? Mutual fund.
See, mutual fund is just it's like a car. It's which helps you get you from your home to your destination. Your destination is your financial goal, and that vehicle basically can help you get you to your destination. To my mind, mutual funds are a way by which you can get small ownership in emerging companies and businesses in India, right? Especially if I talk about equity mutual funds, there are a lot of businesses which you'll see around, right? You get up, you brush your teeth, you take a bath, you use a lot of these products. Finally, these products are built by companies and businesses, and mutual funds have small ownership in all these businesses. So in a way, you are part of your growth story of India. And that's how you would, as these companies grow in future, your small investments in them will also grow.
So when we speak about a mutual fund, and then we have these days a lot of demand for a small cap and mid cap, especially small cap, uh, especially new investors, those who came in 3 years time, 2 years time. Everyone's main attraction is small cap. So could you define what is small cap and mid cap space?
So, see, as of today, SEBI defines it very clearly in the sense that top 100 companies by market cap are defined as large caps. 101st to the next 150 companies are defined as mid caps. And after that, everything else now is called a small cap. So, broadly, a 33,000 crores is where that boundary is. So, anything which is less than, say, 30,000 crores, you can say that it's a small cap today. So, in a way, small caps are these small businesses which are in that early stage of their growth cycle. And if you invest in them early, you can benefit from their growth journey because since they are in that early stage, they, unlike mature businesses which have reached a certain stage of maturity, the growth rates here could be on the higher side.
Okay. So when we look about small cap, anything small, becoming double or triple is a very easy. At the same time, it has a inherent risk associated also because a bigger portion, going for a bankrupt or that kind of a risk is it is there, but it compared to small cap is very less. So could you talk about mortality? Could you talk about that? Risk associated with small cap and mid cap?
No, I think you were about to say that word, I'll say that actually the risk of mortality in small caps is very high. We have done some research on this. Actually, only 10 to 15% of small caps become mid caps and then eventually end up becoming large caps. Large majority of the small caps either remain small cap and small proportion of them get actually delisted. So not every small cap is a great company, and that is the reason is why, because these companies have their own inherent business risks. It could come from the business being very concentrated in a few clients or a few geographies. It could be because maybe the promoter is not able to run the business well, or he doesn't have a good succession plan, or the segment that he is present in is very niche. So maybe he is the market leader in that segment, but maybe that segment cannot grow beyond a certain level. So when you are investing in small caps, while the growth rates could be high, the risks associated with small caps are much higher. So when you are investing in small caps, you need help of an institutionalized framework which can help you eliminate these companies which can create mortality in the portfolio.
Okay. Even when we speak about investing directly into demat account, and we have a lot of attraction for picking up the small cap, and a smaller company is always an attraction, and we get a lot of newses from various portals, and even penny stocks also another attraction. So if you look at the same time we are investing in index also. So investing in active fund versus directly investing in companies, stocks in demat versus investing in ETF in small cap. What is that difference and what is the risk associated?
Yeah. No, so see, I think when you look at small caps, small caps are typically names which are under-owned, undercovered. You will not find a lot of research coverage on them, which means that even institutions, a lot of big institutions won't be knowing about that company. So the amount of due diligence one needs to do to understand that company, to understand that business is very high, right? And you need to track that on a regular basis. Only in an institutional setup which has dedicated resources towards going and meeting companies, meeting managements, doing checking with their competitors, looking at their suppliers, supply chain, then only you can build comfort that yes, this is a genuine great business, and I can stay with these promoters for long term. As an individual, your ability to do that sort of in-depth research is very low, and therefore for you to make more mistakes if you're doing it on your own is very high. So I think it's definitely very risky when you're doing it as an individual. Now, if you look at it as an ETF, if you look at the performance of small cap index, actually over long periods of time, on a risk adjusted basis, because these indices are volatile, actually it underperforms even large cap. So therefore one could question why you want to be in small cap, right? The benefit is that as a fund manager, you can choose good quality companies within that small cap index, which can do much better, have better quality, and therefore can be among those 10-15 companies which can become the mid caps or the large caps of tomorrow. Hence, therefore, again coming back, an institutional framework, a process, which defines which are good businesses, but also avoids wealth destroyers. I think that is very key for long-term sustainable wealth creation in that space. And therefore, having a fund structure is, in my mind, a better way.
Active funds, yeah.
Active funds to look at least the small cap space.
Okay, makes sense. Because if based on the market cap, this particular fund is an ETF, they can take it out also. Otherwise, tracking error will pick up.
Yes.
Yeah.
So you have to buy not only good companies, but poor quality companies also in your portfolio.
You don't have an option as a fund manager when you are duplicating or mimicking whatever the index is.
Yes.
Okay. So if you look at in mid cap and small cap sector, what are the sectors if you clearly watching out and you see that in 5-6 years time this will kind of flourish?
So see, a lot of the approach in mid and small, especially in the smaller space, is more bottom up in nature. So you're looking at individual companies, how they are doing, evolving, and it could be that you're not that positive on the sector, but you could find companies within that sector which are doing something different. But if I look at some of the broader themes that we are seeing, I think consumer discretionary remains one area where as incomes go up, people will spend more on building a better house, building a better lifestyle for themselves, and I think that to our mind is a consistent space for investment by companies. Healthcare and allied space, healthcare services, pharma, I think that again remains a consistent theme. Not only from a perspective of consumption, because healthcare needs will continue to go up, but also as companies who can export to other developed markets. So India is a big manufacturing engine for some of these plays. IT again remains one area where India continues to have, from a supply side perspective, good competitive strength. Because of all the engineers from various engineering colleges in India. I think these are some of the sectors we are looking at, but beyond that also, there are companies which are emerging in the small cap space which have newer business models, right? Your companies in digital advertising, your companies which are doing, great work on the renewable side, and these business models will evolve over a period of time, but they give, an ability for a small cap investor to get exposure to.
Okay. So when we pick up a small cap fund as a category, so what is the kind of a time horizon you should give, for a client to, look small cap as an investment?
I think especially at this point in time, where we are at the stage of the market, I think anyone who is looking at past returns and thinking that you can make quick returns in this, I think that's a very risky proposition for someone. And to be able to get complete benefit, I think at least he should have a 5-year time horizon. I would ideally say he should go to a 10-year time horizon, but I'm sure a lot of investors will not be sort of be that patient. But especially at the time where we are in markets where valuations in the mid and smalls look pretty expensive, I think at least a 5-year time horizon is a bare minimum that one should look at for any reasonable return.
And you would recommend SIP mode or lump sum mode in small cap when you invest?
So at least as of now, it's clearly a SIP mode. I think post-COVID, when we saw massive drawdown, or even maybe a year after that, when actually small caps had not participated in a very big way, lump sum investment still made sense. But today, where we are in the market, definitely it has to be a SIP mode.
SIP mode, yeah, okay. And for example, if a person is investing certain money, and what percentage of allocation should give it for a small cap and what percentage should give it for mid cap? For example, 100 rupees is investing on an SIP mode. Right. So what you would recommend that this much you should keep it for small cap, this much you should for mid cap? Your personal experience also could be, good.
So, I mean, I would say ideally it depends on each individual's goals and risk appetite they have, but, the broad heuristic that we use is that, when you look at the broader market, and when I think of it in terms of NSE 500, the broad allocation to, mid caps will be around 15% and 5 to 10% will be in small caps. I think if I had a market neutral portfolio, one who's, is happy with market returns, I would say that's where I would allocate him in terms of mid caps and small caps. So around 10 to 15% in mid caps and 5 to 10% in small caps. But if you are willing to take and you are early in your life and you want to create some wealth for yourself, maybe you can increase this allocation higher to maybe 30 to 40% in mid and small. I think that's how one could think of it, when you're looking at your asset allocation.
Yeah. So, if, for example, a person is investing new to market, so that time probably you can keep little extra into mid and small, but then they get matured or create certain kind of a wealth, they can reduce that.
Yeah. Because then wealth preservation will become a more important criteria for someone, because I think longevity is very important. If you have more time at your hand, you can maybe weather through different market cycles.
Yeah, I think when we speak about time horizon and allocation, that is concerned. There are people goes with 100% in small cap these days, okay. So these days, not only small cap people get attracted because there are tiny cap and everything. So what is your take on giving more allocation into tiny cap kind of fund allocation?
I would say that the risk of liquidity and all is very high in those names actually. So while you can still find good companies, probably some of them will, but like I said, in a small cap 250 index itself, I would see that the mortality risk was 80-85%. In tiny caps, that mortality risks will, go much higher. And therefore, what is your ability to identify that, 5% opportunity available in the market? I think that's something which one should question, and liquidity again is a big, today when markets are good, liquidity might be available in some of these names. But the first sign of bear market when it comes in, you will see liquidity completely drying up in a lot of these mid and small cap names. I think that risk is clearly underestimated by market. Especially when you think about, I'm owning 4 or 5 concentrated names in my portfolio, but what liquidity can do to you, I mean, it's very difficult to, understand.
Yeah. Okay. And when we pick up small cap, funds, and because there is a lot of funds got a lot of funds, and so there are a lot of AUMs in certain funds. Then at the same time, there are some funds has more than 150, 150 odd companies in the portfolio itself. So what would be the risk associated in terms of bigger AUM and at the same time more number of stocks in one portfolio, especially small cap?
Actually, funnily enough, one would imagine that as you get larger, your ability to outperform comes down, right? But I mean, there is enough evidence in the market, that there is no one way of outperforming, right? I've seen funds who have a very high number of stocks and they have done reasonably well. There are funds which are very concentrated, they do well in some markets, don't do well in some markets. Big funds sometimes outperform, small funds are underperform. So I think, to my mind, it's more to do with the, what is the selection of stocks. Actually, finally, I think it matters what is your selection of stocks and how are you placed in the current macro context, which creates that outperformance for you, right? Like for example, if I am in the right sector, I could play a stock by owning 5 names in the sector or just 1 name in the sector, right? But what is more important is that I identified that sector well in advance and I have good exposure in it, right? So there is no very clear view that size, is a big hindrance or number of stocks. Finally, what matters is what is your active share and how are you placed in the opportunities that will do well in the future.
Okay, makes sense. Okay, and when you say about selection criteria, so what would be your some small filters or some area which you see that, okay, these are the way I pick up my stocks when you pick up a company? In a simple terms, what are the criteria you will be looking to pick up the stocks in your portfolio?
So very simply, I'm looking at companies which have good quality managements, who have a track or balance sheets which are debt-free balance sheets with high ROC companies which don't have too much volatility in the business, where if it is a B2C business and they have been able to create a big brand for themselves, you'd want to bet on some of these businesses. So typically you're looking at the end of the day, companies which can generate high returns on whatever capital that they have invested in their business, and businesses which can generate very high operating cash flows.
Okay.
And that's the framework that we use within UTI also to look at businesses, evaluate them, and depending on the philosophies of different funds, you can see those elements of high ROC, high operating cash flow in their portfolios.
Okay, good. And these days we have a PMS is something which is a pretty good interest among people. If you look at the percentage of growth, which is much higher than mutual fund penetration, if you look at it. So what's your take on, especially when we are investing in small and mid, investing via mutual fund versus investing via portfolio management?
Sure. No, I think both these strategies will have a place in the market. I think for an investor who's getting into a PMS, for him, some of the things that he needs to ponder more is, see, mutual funds are highly regulated today. So much so that there's a lot of scrutiny, a lot of regulation on how you are reporting performance, how you can do trades, how you can reporting requirements, etc. So one thing that an investor can be rest assured of, what he sees in terms is what he'll get, right? I would say PMSs are still relatively while regulations, I'm sure over there also have gone up, but much less regulated as, say, compared to mutual funds. Secondly, one should look at at the end of the day, one would have to see over and above a mutual fund, what's the value add that strategy is doing. And in it, when you look at returns, you have to not only look at gross returns that the portfolio generate, but ex fee, ex taxation, what's
post tax and post
tax and post fee, how's the return generating? Because the fee structure as far as mutual funds are concerned are fairly stable, and they keep reducing as the AUM of the fund stock keeps going up. So I think while obviously there is a place for PMS, but when an investor is looking at comparing between PMSs and mutual funds, he has to understand some of these nuances.
It's more of an individual choice than which one is good and bad.
Yes.
Yeah.
And what suits his particular risk appetite, right? And
Okay, good. It's a great interaction, and I'm sure that we have a lot of my set of audience has a lot of interest for small cap and even mid cap also. We keep chasing for which one is a best return fund on a year on year basis. In 5 year time, we have seen that every year it's keep on changing it. So with this, what is your final advice for Kerala audience and my audience?
no, I think India is a great place for investors, because I think next 5 to 10 years, I do believe very strongly that it's for India, and within that we have seen this massive growth of entrepreneurship, which to my mind will build these new businesses, and which will come into listing at some point in time, and a lot of these businesses become part of this mid and small cap universe. So it looks quite optimistic for the next 5 to 10 years. Just that the near term, from a valuation perspective, looks a little bit expensive. So be more calibrated, have exposure to equities, because that's what will create wealth and return for you in the long term. But as if you go into mid and small, be with an institutional framework, because it is more to reduce risks in your portfolio.
Research will be better.
Returns will automatically come.
Yeah, the risk-adjusted return will be better.
That will be better.
Okay. Thank you so much. I think it's a busy day for you. I think you have met multiple group meetings and everything, and you have taken time out for us, and that is much appreciated, sir. And this, I'm sure that after this discussion, people when they listen, they will able to gain a lot of confidence about market and mutual fund, and at the same time they will get a lot of knowledge about mid cap and small cap, and they can able to take a decision based on this.
Sure. Thank you.
Yeah. Thank you so much. Thank you.